All right, let's talk about West Pharmaceutical. They're one of those critical behind-the-scenes players in the massive injectable drug market, and they just dropped a third-quarter earnings report that absolutely lit a fire under their stock. So today, we're going to break down exactly what happened and why everyone's so excited. And when I say lit a fire, I mean it. Look at that, an almost 11% pop in a single day. You just don't see that without some seriously good news. This is the market basically shouting its approval from the rooftops, especially after the stock had a pretty shaky start to the year. And that's really the core of the story here. The stock kind of slumped early in 2025 because of a weak outlook that spooked investors. Well, this quarter just completely rewrote that script. It was a massive, decisive turning point for the company. So, what was actually in the report? What was the secret sauce behind this huge rally? Let's get into the numbers. Here we go, a clean sweep. Analysts were looking for about $1.69 in adjusted earnings per share. West came in and delivered $1.96. I mean, that's not just a beat, that's a huge statement. And revenue came in strong too, clearing expectations by more than $16 million. This was just strength across the board. And this really shows you what I'm talking about. This wasn't some fluke. This wasn't a case of just cutting costs to make a number look good. This beat was fueled by genuine, solid customer demand for their products. Now, for me, this is where it gets really interesting. It's about the quality of those earnings. Gross margins expanded by 120 basis points. That's 1.2% compared to last year. What that tells you is they're not just selling more stuff, they're selling it more profitably. That points to fantastic operational control and, crucially, a shift toward their best, highest value products. So we've established the results were impressive. But why? Where did all that growth actually come from? Let's take a look under the hood at the engine that drove this whole quarter. If you remember one number from this whole thing, make it this one, 13.3%. That was the organic growth in their high-value products, or HVP business. This is Westy's crown jewel, folks. It's their largest and most profitable segment, and it absolutely crushed it. So what's driving HVP? Well, a huge piece of the puzzle is the single hottest area in the entire pharmaceutical world right now, GLP-1 drugs for diabetes and obesity. West is a key supplier for these blockbuster treatments, and as you can see, that exposure is becoming a really significant part of their business. This is the growth story that investors are betting big on. Now, management laid this out pretty clearly. They said the HVP strength really stands on three pillars. First, you've got that undeniable GLP-1 demand. Second, the broader biologics market is recovering, and customer ordering is finally getting back to normal. And third, and this is a big one, customers are upgrading to high-value components faster than ever. This is being driven by new European regulations called Annex-1 that basically force drug makers to use better, safer, and for West, higher margin products. And the CEO, Eric Green, really just summed up the whole vibe of the earnings call with this quote. It's confident, it's direct, and it's a clear signal that they believe this isn't just a one-time thing. Okay, so the quarter was fantastic. No doubt about it. But the big question for any investor is, can they keep it up? Is this sustainable? That brings us to the all-important guidance. And their answer was a resounding yes. This was a classic beat-and-raise quarter. They lifted their outlook for the full year. And look at this. The sales guidance gets a nice little bump, but the adjusted EPS range takes a huge leap forward. The new midpoint of their earnings guidance is now way above the old high end. That screams confidence in future profitability. Now, at first glance, the implied forecast for Q4 might look a little weak, but you have to know the context. They're comparing against a quarter last year that had a one-time $25 million incentive fee in it. So if you pull that out to get a true apples-to-apples comparison, the underlying momentum is actually still very strong heading into the end of the year. And they even gave us a little sneak peek into 2026. The new CFO basically said the inventory issues that have been plaguing the whole industry are now largely behind us, and that all those key growth drivers we just talked about, well, they're going to continue to get better. That's a great sign. All right, let's put it all together. We've seen the numbers, we've heard from management. What does it all mean for the stock going forward? This is our take. So, the stock just had a double-digit pop. Management sounds super confident. What's the play? What's the trade from here? We are initiating with an outperform reading. We think this positive momentum has legs and is here to stay. And here's our outrageous but plausible trade idea. Our core thesis is this. The market sees the good quarter, but we think it's still underestimating just how powerful this shift to high-value products is for their long-term profit margins. The catalysts are crystal clear. The GLP-1 wave isn't stopping. That Annex-1 regulation is going to keep pushing customers to their premium products. And we're betting the new CFO finds even more ways to run the business efficiently next year. Our prediction? Another beat and raise in Q4, which pushes the stock to retest its old highs. We see a bull case for this stock heads for the high end of the new analyst range, somewhere between $370 and $390 a share. And as always, please remember this is not financial advice.